Hello. Welcome back to Gold Off the Charts. In this financial market full of twists, games, and uncertainty, we don't just focus on the surface excitement, we focus on the deeper picture. A bit of thoughtful financial insight every day hopes to help you see further than others, act more steadily than others, and preserve your wealth longer than others. Yesterday, Trump once again performed his classic drama, Taco. Trump always chickens out, meaning he tends to back away at the last minute. As Trump's attitude on the Greenland issue suddenly softened, the market's need for risk aversion instantly cooled down. The price of gold acted like a thrilling roller coaster, plunging all the way from the session's all-time highs, falling as much as $130. This swing can worry many short-term investors chasing quick gains. But, folks, is this a random event? If you watched our video on Monday, you shouldn't be surprised at all. We made it very clear at the time, Trump's sudden fuss about Greenland is probably just a repeat of his extreme pressure tactic, aiming to gain leverage in upcoming negotiations. He's not planning to really go to war. As expected, the market moved according to our script. Faced with this level of shock, I know the market is full of noise right now. Many people are asking, Trump admitted he was bluffing, the need for hedging is gone, and gold has risen too much, should I sell? But today, I want to make this clear right here. Don't let short-term shocks blind you. This pullback may be a healthy and necessary step before gold heads toward $5,000. Why am I so confident? Why do I see a setup for a historic gold surge while others worry Trump's confession will lower prices? Because what happened in the past 2 days is far more profound than just the rise and fall on a candlestick chart. What we are experiencing is not just a price fluctuation, it is a total collapse of the international political landscape established after World War II, a rehearsal for a great migration of global capital. How will the next market phase be interpreted? Will it continue to fall? Or will we see a V-shaped reversal? How should we respond to this volatility? Are you fearful and stopping out? Or greedy and looking to increase positions? Why is now a historic opportunity? How can we hold on to this ticket to the future? After this video, you'll understand why I said, the current shock is just the calm before the storm. The real historic opportunity is just starting to appear. This video may change how you view this wave. Sit firm, adjust your mindset, and let's start. First, we need to review the direct reasons behind yesterday's sharp gold drop. All of this stems from our old friend, US President Trump, who once again staged his classic art of trading. Let's see how the story unfolded. On Monday, Trump made a big fuss on social media, posting an image saying that he would buy Greenland and threatening to impose tariffs on Europe, acting as if he was going to go to war with the world. At that time, the market was frightened, gold soared, and US stocks dived. The result? Less than 48 hours later, the tone changed abruptly. At the World Economic Forum in Davos, Switzerland, Trump delivered a speech that made the market feel relieved and even seemed a little conciliatory. He made it clear that the United States does not intend to acquire Greenland by military means. Once he said this, the risk of war vanished, and then he stressed immediate negotiations. He added that he would not impose tariffs on Europe for now and even claimed to have a framework for future agreements. Another typical taco moment. The aggressive Trump who threatened on Twitter and wielded tariffs disappeared, replaced by a Trump willing to sit down, compromise, and negotiate business. Has begun a cycle of interest rate cuts. This is very simple economic logic. Gold pays no interest, so holding it has a cost. The S&P 500 rose 1.2%, one of the biggest single-day gains since last November, and bond yields turned positive. Safe haven assets naturally became targets for selling. Gold, as the king of risk aversion, bore the brunt of the selling and experienced a sharp pullback. This confirms our judgment in Monday's video. When Trump made a big fuss in Greenland, it is repeating an old technique of putting maximum pressure. He is bluffing to get more chips at the negotiating table. When opponents like Europe show toughness, or when he thinks he has enough chips, he will find a step down, declare victory, and retreat. But does this mean the world is suddenly peaceful? Does this mean gold's safe haven logic has vanished? Absolutely not. Trump's pressure tactics may gain short-term benefits, allowing him to show toughness domestically and lift the stock market briefly, but long-term, this unpredictability harms trust and allies, treats international rules as child's play, and causes irreversible harm. This kind of damage is called a collapse of trust. Every time he cries wolf and every taco moment depletes the national credit of the United States. It is accelerating the defection of allies and the suspicion global funds have regarding US dollar assets. It's like a partner who always points a gun at your head to force you to sign a contract, even though he doesn't shoot in the end, even though he finally puts down the gun and says, "Just kidding, would you still trust him?" No. You start seeking alternatives, moving assets, and finding a safer financial umbrella. This is the core reason gold remains strong. When hegemony fails and rules are ignored, gold becomes the ultimate safe haven. To confirm this, we must set our sights on this Davos forum. This meeting may be written into future history textbooks, marking the shift in international order since World War II. At Davos, we no longer hear old cliches about globalization or win-win cooperation, but instead the angry roar of American allies, the sound of the old order cracking. Let's first look at what America's closest neighbor Canada says. Canadian Prime Minister Carney delivered an extremely strongly worded speech in Davos, almost explosive. He said bluntly that Canada strongly opposes the U.S. tariffs imposed in relation to Greenland. Note that he uses the words strongly opposes, which is very heavy in diplomatic rhetoric. He pointed out that recently, some major powers, in this case, obviously the United States, have used tariffs as leverage for pressure and financial infrastructure as a tool of coercion. He warned that the institutional framework for collective problem-solving, including the World Trade Organization and the United Nations, is under threat. He even issued a deafening warning. Middle powers must wake up. What does this mean? It's a call for countries like Canada, Australia, and Europe to realize the U.S. is no longer the only power. He declared that the rules-based international order established after World War II is dying. The world is moving toward zero-sum games among great powers. Strong nations can do as they please. Weaker nations must endure. At Davos, before the global elite, the Canadian Prime Minister openly called the U.S. a hegemonic country, doing whatever it wants. This was unthinkable 10 years ago, or even 5 years ago. Similar voices come from Europe, like France. French President Emmanuel Macron also made a similar speech. In the face of the growing trade threat across the Atlantic, Macron did not choose to swallow his anger. Instead, he chose a clear line, politically toughly countering Trump's bullying diplomacy and extending an olive branch to the east economically. Macron was pragmatic, realizing Europe could no longer fully rely on U.S. security or markets. Europe must pursue strategic independence. This makes the Davos Forum extremely significant. It marks a structural shift in international politics and finance after World War II. The rift in the Western alliance has become public and normalized. When the allies of the United States begin to wake up, begin to look for new ways out, and begin to question the dollar system, it will provide a steady stream of fuel for gold's rise. Because in a world where there is no trust, no rules, and allies are antagonistic, only gold is the last and eternal support. Given this macro backdrop, even with short-term pullbacks, I am more optimistic about gold's long-term trend than ever. Here are 5 core reasons gold is set to rise and may eventually hit 5,000. Each reason is solid and irreversible. In the current gold market, the most determined group of bullish buyers are those who have doubts about the stability of the US dollar and other major reserve currencies. For them, gold, as a hard currency spanning thousands of years, is the ultimate store of value to resist currency depreciation and hedge against economic shocks. Trump's recent series of aggressive policies, military threats to Venezuela, erosion of the independence of the Federal Reserve, and tariff sticks waved at allies are weakening the credit base of the dollar. This triggered what Wall Street calls a currency devaluation trade. The core of market concerns is the loss of government fiscal discipline, the failure of inflation control, and the expansion of debt. Back in early 2025, when the Trump administration introduced intensive tariff measures, the US dollar index plummeted by 12% in half a year. Now, history is repeating itself. Not only the US dollar, but also the Eurozone's public debt as a percentage of GDP has exceeded 120%, and Japan's total debt is as high as 260%. When the world's major currencies become rotten apples, gold becomes the ultimate golden apple. As a TD Securities strategist said, gold's rise reflects confidence in the global credit system. Once the trust system collapses, gold's upward momentum will far exceed current levels, and 5,000 may just be a halfway point. In response to economic slowdown and political pressure, the Federal Reserve has begun a cycle of interest rate cuts. This is very simple economic logic. Gold pays no interest, so holding it has a cost. When rates are high, U.S. bonds yield 5%. Gold lags. As rates fall, bonds yield less, lowering the cost of holding gold. This directly reduces the opportunity cost of holding gold. Goldman Sachs analysts calculated some very surprising data in their latest report. Currently, gold ETF holdings account for only 0.17% of U.S. private financial portfolios, which is at a historically low level. If just 0.1% of the $7.7 trillion in money market funds turns to gold, the price of gold is expected to directly break through $5,500 per ounce. The potential of this reallocation of stock funds is huge and is a torrent of money we cannot imagine. We have repeatedly emphasized this before, but this is still the most important support. Central banks around the world have shifted from being sellers of gold to steadfast buyers, regardless of cost. In particular, countries with tense relations with the West, such as China and Russia, are accelerating the shift of foreign exchange reserves from the US dollar to gold to avoid the risk of financial weaponization. According to data from the World Gold Council, the People's Bank of China will increase its gold reserves by 280 tons in 2025, increasing its holdings for the 18th consecutive month. Not only China and Russia, but Poland and other European countries are also increasing their holdings to stabilize their exchange rates. The Central Bank of Poland announced on Tuesday that it had approved the purchase of 100 tons of gold. This central bank buying behavior not only increases underlying demand, but also sends a strong bullish signal to the market. Even the people who print money are buying gold. What reason do you have not to buy it? Gold prices hit new highs in tandem with major global stock markets. However, high stock market valuations have caused widespread concern. The current CAPE valuation of the S&P 500 index has reached 38 times. In the past 100 years of history, this was only ever exceeded before the dot-com bubble in the year 2000. Technology stocks became the core of the bubble. The total market capitalization of the Magnificent Seven U.S. stocks has accounted for more than 35% of the S&P 500, forming the ultimate winner-takes-all pattern. On January 20th, these seven stocks of the U.S. stock market collectively closed down, with a total market value of $683 billion evaporating in a single day, while small and medium-cap stocks also fell. This suggests that investors are accelerating their exodus from high-valuation, large-cap tech stocks. Where do funds go when they withdraw from the stock market? The bond market has inflation risks, the property market has liquidity risks, and cryptocurrencies are too volatile. Gold, as a traditional hedging target, naturally attracts money, creating a stock-gold seesaw. Market psychology matters. Historically, gold bull runs are long and strong. Citigroup found that after annual gains above 20%, gold rose another 15.3% on average the following year. This pattern repeats in 2025. After a 27% growth in 2024, the price of gold could rise sharply by 65% again in 2025. From a technical point of view, after the current gold price broke through the key resistance level of 4,500, gold follows a healthy break, consolidate, rise trend. Yesterday's pullback was a textbook retracement. Moving averages remain bullish, volume continues to expand, and trend-following funds are entering. Institutional optimism is at historic highs. Goldman Sachs and Citigroup raised forecasts. Some predicted 6,000, 7,000, while Saxo Bank even sees 10,000. Once Wall Street consensus forms, this force becomes extremely powerful. So how should ordinary investors act in this unprecedented bull market, especially amid taco-driven volatility? My trading philosophy can be summarized in 8 words. Trade trends only, ignore the noise. Why is volatile trading so hard? Prices bounce between highs and lows. Chasing breakouts can leave you trapped. You think you've hit the bottom, only to see prices fall further, shaking your confidence. These moves are mostly fake signals. This mainly hurts frequent traders trying to catch every swing. My advice is simple. Ignore the noise and trade clear trends only. Don't worry about small gains. If the market is stuck, direction unknown, stay put. Right now, gold surged too fast and needs a breather. Support lies near 4,770, while 4,854,900 form strong resistance. Price keeps oscillating within this range. Long-term, global instability supports gold, But short-term, it needs time to digest gains and shake out weak hands frightened by Trump's words. In such periods, no trade is the best trade. No action means fewer mistakes, safer capital, and a calmer mindset. This is far smarter than guessing the next tick. So when should we act? When the market clearly chooses a direction, there are only two scenarios. First, gold builds enough strength to break decisively above 4,850 and hold. That's like an athlete breaking through the starting line, signaling a new uptrend where we can follow and ride the main wave. Second, gold fails and breaks below 4,750, indicating a deeper correction toward 4,700 or lower. Then we can look for better long-term buying opportunities around 4,600 or 4,500. Aside from these two signals, if price remains range-bound, I stay still. Patience is key. In trading, focus matters more than technique, and discipline matters more than prediction. The market never lacks opportunities. Patience is what's scarce. If you engrave avoid ranges, trade trends into your mind, you can avoid 80% of market pain. Now, to conclude, although Trump's taco caused short-term gold volatility, it cannot change the broader collapse of the post-World War II global order. It cannot reverse the dollar's long-term credibility decline, nor the global rush by central banks to buy gold. Gold moving toward 5,000 or even 6,000 is historically inevitable. For ordinary investors, this pullback is not a disaster, but a gift, time to think, prepare capital, and stabilize mindset. If recent markets make you anxious or exhausted, stop for a moment. Turn off the screens and calm down. Our goal is not to trade every day. Our goal is to be ready with capital, clarity, and decisiveness when a clear trend arrives. We are standing at a historical turning point. This is a redistribution of wealth. I hope we can hold our chips, become friends with time, and wait for wealth to bloom. Finally, a reminder. All analysis above reflects my observations based on current market data, news, and logic meant to help organize your thinking. It does not constitute direct trading advice. Markets carry risk, and trading requires caution. Everyone's risk tolerance and financial situation differ, so decisions must be made independently. Others' views are references. Only your own judgment is what matters. That's all for today. If these insights helped clarify this complex market logic, leave a comment and share your thoughts. Don't forget to like and subscribe to Gold Off the Charts, and share this video with someone who is interested in finance. See you next time.